8, 10, 15. Okay. That's capital spending. Okay, during year zero, which numbers, if any, over there I need to consider as spending? Well, let's ask. Should I consider cost of the factory as relevant spending? I mean, it is not a rhetorical question. Doesn't mean it's a complicated question either, but I mean, you're going to have to spend that money if you want to put the project in place, right? So that number is relevant because without the factory, you don't have the projects. How about the equipment? Do I need that? Yes, I do. How about cost of the land at the time the company purchased it 3 years ago? Is that relevant? No, it's not, because that's the cost then. Because company already owns it. Okay, so I mean it's not technically sunk cost, but it's not relevant for us. How about the value of the land now? Is that relevant? I mean the project doesn't need to spend that $10 million. So is it relevant or not? Somebody weigh in on that. Come on, guys. I won't hurt you much if you actually show courage and talk about it. It's okay to be wrong. This is the place where we learn why we're wrong. That's sometimes more important to know than why you're right. Hmm? No. What's the criteria we're using to decide whether or not that's relevant? It's the standalone principle. If the firm had not owned that land, do I need that land to put the factory in? Yes. Unless we're doing it in space. So if the company had not already owned the land, I would have had to buy it, and it would have cost me $10 million. Remember the opportunity cost? That's the opportunity cost. Because if the firm doesn't give you that land, they could have sold it in the market. By giving you that land, they give up the chance to sell it in the market. That's the opportunity cost. Hence, it's relevant. Even though there is no real cash coming out of the firm, as far as the project is concerned, it's a relevant cost. So I'm going to add value of the land now. Okay. Well, value of the land at the end of the project is not relevant at this point. So year zero capital spending is 120,000. Okay. We already know that there is no capital spending in years 1 through 7. How about year 8? What's going to happen at the end of the project? One, I'm going to get salvage values from the factory and the machinery equipment, which we haven't calculated yet, but we know how to do given our template. And two, I'm going to return that land back to the firm. Say, okay, I used it. Now give me the value of the land as a cash inflow. Technically, there's no cash going on, but remember, that project is a standalone entity. So project paid 10 million to the firm. Now it wants 15 million. It's like a repo transaction in bonds. Repo is short for repurchase. If I want to borrow money from you and I go ahead and say, please lend me $1 million and I'm going to give you treasury bonds as collateral. And basically, I'm selling you my bonds to you at $1 million now. 1 month from now, I'm going to buy them back from you at a higher value. The difference being the interest, of course. That's called a repurchase transaction. It's pretty much what we're going to do here. So this 15 million is going to be negative capital spending. So I'm going to let me copy and paste this for the format. I'm going to start with that. So I have at least negative 15 million capital spending or 15 million recovery value. But I also need salvage. So this is my template for salvage. Let me make 2 copies of that. Let's call this factory salvage. And I'll make a copy of that as well. Machine salvage. I mean, ideally, I would have actually had a button here. When you push that button, it automatically makes a copy of itself. All right, factory. I'm spending 60 million on it. And before taxes, I assumed I'm gonna get how much for it? 15. My tax rate is 25. Tax life of this asset is 20 years. Okay. No, 15 years, I'm sorry. And project has an 8-year life, and it is makers. All right. This is why we built this calculator. What was your name? Caleb? This is why we built this calculator, not only to calculate depreciation amounts for all of those years, which we're going to need later on anyway, but also given those, calculate what is the after-tax salvage value, because that depends upon how much money, how much you charge depreciation during the life of the project. Well, turns out the book value of the factory at the end of the project would have been 26 something. Well, I'm getting only 15, which means that I am losing money as far as IRS is concerned. Hence, they're going to give us a tax credit. That's what negative salvage tax means. So after tax salvage is actually higher than the 15, almost $18 million. Well, I'm going to do the same thing for the machines. It cost me 50. I can sell it for 20, I think. Tax rate 25, but this has a 10 years depreciation tax life. Project is 8 years and it is makers. Let me make sure that my cost salvage is 20. In this case, as far as IRS is concerned, I actually made money on the deal. Hence, they're going to charge me taxes. And my after tax salvage is 17 or 7. Are they the same? They're close. No, okay. If I had, different assets with different tax lives, obviously, I would have calculated salvage for them as well. In fact, your homework assignment will have, I think, 5 different kinds of assets. So to this, I'm going to deduct the salvage value of the after-tax salvage value of the factory and after-tax salvage value of the machinery. It's a minus because these are that column calculates spending. If you're getting money, that's negative spending. So I'm actually getting about $50 million back at the end of the project. Of course, I'm getting that back with an 8-year delay. So it's not necessarily clear that I'm making that much money out of it. So that part is done. Next, we're going to have to calculate change in net working capital. And that D, I want that to be Greek. You can apply separate formats to individual characters within a cell. For example, I can make that red if I wanted to. Was that my phone? I said I put it to silent. But the way we set it up,